In this episode, I'll be taking you through the best way to use indicators in order to build algorithmic trading systems. Indicators are often badly misused, and when they are, this leads to ineffective trading systems that don't reach the potential that you first anticipated. So today I'll be giving you advice firstly on how to select the most appropriate indicators for algo systems, and secondly, which to avoid. But as you can probably imagine, it's not quite as simple as that. So I'll be giving you advice on the circumstances for using different types of indicators. Now, the first rule, and one that is probably the most important, is don't start your system development process by choosing indicators. Far too many people do this, but it's a huge mistake. And it's also very unlikely to produce a successful system. Instead, you should always start your process by first defining your system's premise. So what do I mean by the premise? Well, it's the fundamental thing that you're trying to exploit in the markets. It includes what type of market your system is targeting. So is it a trending market or a trading range market? And most importantly, of course, it's what is the edge that you're attempting to exploit. And once you've defined that, then and only then should you explore which indicators will allow you to exploit that edge most effectively. So let's now talk a little bit about indicator choice. The first principle that I always use is choosing indicators that have a basis that's easily understood. Now, whenever you develop a system using indicators, you need to implicitly understand what the rationale is behind the calculation of those indicators. And only when you have this thorough understanding will you then be able to properly interpret what the indicator is telling you and when. So you need to choose indicators, of course, that specifically meet the objectives set out by your premise. And this is how indicators should be used, not merely as a tool to backtest to see what kind of equity curve they give you. And my advice is to avoid any indicator that you don't fully understand. How can you possibly hope to make them effective if you don't understand exactly what and how they are doing things? So let me give you an example of this for me personally. So an indicator that I've always struggled with is ADX, the average directional indicator. Now, I understand that this is an extremely popular indicator. There's lots of traders using it, and I'm sure there's lots of traders who are using it successfully. However, for me personally, I like to keep things really simple. And the ADX calculation is far from that. It's quite a complex, lengthy process with multiple stages along the way in terms of that calculation, and you can see a representation of that here. Now, there are so many steps to this calculation that need to be performed. I don't feel I can get a good grasp of what the indicator is really telling me and the information that that indicator is giving out. Now, don't misunderstand me. I understand the calculation and I can do the calculation, but in terms of the information it's giving out, I'm much less sure of this. And yes, you can read what different websites say and different bloggers say about how to use this indicator. And I get that. I understand that. But unless I personally have a thorough understanding of the information it's providing, I'm not happy to use it. And that is the case with ADX for me. So let me now compare this to an indicator that I do use, the stochastic oscillator. Now, the basis behind this is extremely simple, and it's really clear to me how this indicator provides information about the momentum of the price. And it does that by comparing the current price with the recent high-low range. Here's the calculation, extremely simple to understand, but more importantly, the information this indicator gives out is also extremely simple to understand. Now, the second line of stochastic, which is known as the percentage D, is simply a signal line, so it's a 3-day SMA of the %K. And in a nutshell, this indicator looks at where the price is right now in relation to that range over the past 14 days or whatever number of periods you choose to use for the indicator. So it's the instantaneous momentum. So looking at this chart, if we look at the price range over the last 14 periods, we have a high value, we have a low value, and of course we have the current price. And depending on where the current price is in that range determines what the stochastic result is. So if the price is close to the top of the range, it will be giving values close to 100, and if the current price is close to the bottom of the range, it will be giving values close to 0. And it really is as simple as that. So in a nutshell, that's my first principle for selecting your indicators. Simple, in my view, is always best. Fully understandable so that you can put that indicator to best effect. So let's now move on to the second principle. And for algo traders especially, this is really important. And it's based around choosing relative-based indicators. So ones that use relative calculations as opposed to absolute price-based calculations. And the way of determining this is to look at the range of the values across different assets and also different time frames. And if the range is always the same, as it is for stochastic, for example, where this range is between 0 and 100, then that is a bounded indicator between those values and is based on a relative calculation. Now, why should you avoid indicators that are unbounded? And the problem here is when you start to change to different time frames and also different assets. So if you're trading, let's say, a stock index that has a value of 7,000, that's going to give you very, very different indicator results compared with a Forex pair that's trading at 1.3. Now what this means is that you won't be able to optimize parameter values across different timeframes and assets with this type of indicator. So you can completely forget the use of, for example, a multi-symbol EA. It simply will not work. But if you're optimizing using something like stochastic, that you know always ranges from 0 to 100 regardless of the price of the asset, then multi-symbol backtesting becomes a reality. Okay, so next I'm going to show you some examples of this on charts, but also explain to you an exception to the rule, where it is actually advantageous to use absolute value indicators even if you are an algo trader. So click top right now to go to the next part.